All right, hello, and welcome back to the Broken Business Models podcast. We're your hosts, Ryan and James. And before we get into today's podcast, just a quick disclaimer how we start each of these. Nothing in this podcast should be taken as investment advice. James or I could have positions in any stock that we mention in this podcast, and we reserve the right to change those positions at any time, with or without notice. So make sure you do your own work and always consult a professional before making any investment decision. So, with that being said, the topic of today's podcast is going to be PureCycle Technologies. We previously made a video on PureCycle a few months ago, but for just a quick background for those who may have missed that one, PureCycle is a startup that uses a new type of technology that is better at recycling certain types of plastics. So, certain types of plastics that are very hard to recycle and that can only be used to create non-food safe, kind of opaque and odorous, like low quality materials. PureCycle has this new technology that can turn those hard to recycle materials into very high quality plastics. um, so this technology was not developed by PureCycle themselves. It was actually developed by Procter and Gamble, but Procter and Gamble agreed to license the technology to PureCycle for just $2.5 million. And the reason that they were willing to license the technology for such a low amount is likely because of the difficulties involved in commercializing the technology. So this technology involves very high pressures, very high temperatures and other extreme types of chemical processes. And because of that, PureCycle has had a very hard time getting to production operations. So they've been plagued by many delays and other problems over the past 3 years, and that is culminated in massive losses. So they lost about $100 million in free cash flow in the first half of 2024, and to this date, they have not been able to generate any appreciable revenue. So, getting into a little bit more about the operational difficulties and their timeline over the past few years. So, they promised commercial scale production to begin 2 years ago, but since then, they've had uh, various excuses for the delays that they've experienced. Um, and they've failed to meet multiple milestones set by some certain large investors. Some of these excuses that they've given are things like they got delayed deliveries of equipment and uh, power outages that forced them to take their production offline. But more recently, they've also started to admit some challenges with the actual technology itself. So specifically, they've been having difficulties removing a certain type of contaminant from their feedstock. And again, all these delays have culminated in them never having been able to achieve any material revenue. All these difficulties have contributed to a financially desperate situation for the company at this point. So, as I mentioned before, they lost 100. They generated free cash flow of negative $100 million in the first half of 2024, which puts them at only $10 million of cash and equivalents as of their most recent 10Q. Now, this desperate situation has forced them to recently raise a huge amount of equity in the form of a $90 million equity raise, which is going to be the topic of today's podcast because it also caused the stock to skyrocket and more than double. So, to get into the details of this recent equity raise and the accompanying stock price surge, I'll hand it over to you, James.
Thank you. So before we get into that, just real quick, a reminder about our website, differentiatedanalytics.com. So this is a website that we run where we find our what we believe are our most compelling short selling ideas. So we identify companies that we believe to be either fraudulent, overvalued, or otherwise operating unviable business models. We then write professional grade short selling research reports, which are available to our premium subscribers on Differentiated Analytics. So, if that at all sounds interesting to you, make sure to check out differentiatedanalytics.com. The link is also in the description below this video. So, with that being said, let's get back into PureCycle Technologies. So, as Ryan just alluded to, PureCycle's stock has, almost doubled just over the past few days after they announced a $90 million equity raise. And at the same time, this was on September 11th that they made the announcement, and the stock price started surging. In addition to the equity raise, they also announced an operational update about their facility. So we'll go through both of these two things, the equity raise and the operational update, and look at why that created this almost doubling in the stock price. So just here, this is a picture of their facility in Ironton, Ohio. This is, they have this one large facility, which Ryan was talking about, that was supposed to begin commercial scale production all the way back in 2022. They have experienced numerous delays in ramping up production. As of the second quarter of 2024, which is the most recent earnings release that which is, the most recent 10Q that we have for them, they have not yet generated material revenue from the factory, but they claim that they're at an inflection point, and they claim that in Q3 of this year, so the current quarter, they're finally ramping up production and are finally going to start generating significant revenue going into the end of the year. So let's dig a little bit deeper about the operational updates that have transpired since our previous video, and also how that ties into the operational update they just gave on September 11th. So one of the biggest selling points of PureCycle technology originally, if you go back all the way back to their SPAC presentation in 2021, and the original selling point of why this is supposed to be such a great technology, is they claimed that you could take the feedstock of polypropylene waste and create a new recycled polypropylene that is of extremely high quality and basically indistinguishable from virgin polypropylene. However, in their Q2 results, in their Q2 presentation, they revealed that the product quality of their output is not as good as expected. So it was originally supposed to be, their output would be so good that it's almost indistinguishable from virgin polypropylene. It turns out this is not the case. There are issues, with the consistency and whatever. There are still some contaminants and some imperfections in their final output. So their recycled polypropylene is basically unusable by itself because there are imperfections and other issues with it. So how they are planning to get around this is to do something called compounding. So what is compounding? In compounding, they take their recycled plastic and then they combine it with virgin plastic and other materials. So instead of just having recycled plastic that you can use to make, whatever plastic materials you need to make, instead you have to get a mixture that is some percentage virgin plastic and some percentage of PureCycle's recycled plastic, and you can mix it together. But because of the impurities and imperfections in PureCycle's product, it cannot be used on its own. So clearly, the quality of their output is worse than expected. And so, from a business perspective, how this is going to work is PureCycle is going to create their recycled output. They are going to pay a third-party compounder to mix their recycled plastic with virgin plastic, and then that compounded product will then be sold to end customers. So it's, you're adding another step in the process. So now let's get into production. As we talked about earlier, PureCycle has had numerous production delays, but in their Q2 2024 earnings presentation, released August 8th up here, they said that they were at an inflection point and they were in the third quarter going to start massively ramping up production. Specifically, they said that their target was to produce 200,000 pounds of production per day and to produce 1 million pounds of production per week by the third quarter. So they have not yet released third quarter results yet, obviously, because the third quarter has not yet ended. But on September 11th, they did give an update about their operations. And they said the company is pleased to report that it has already achieved feed rates of over 10,000 pounds per hour and has twice processed more than 200,000 pounds of feedstock in one day. Now, on the surface, this might sound like a good thing, like they achieved their target of 200,000 pounds of productions per one day. However, if you count the number of days from the beginning of Q3 through September 11th, that has been thus far, at this point, there had already been 73 days during that period from the beginning of the third quarter through September 11th. So in the first 73 days of the third quarter, they only achieved they only processed 200,000 pounds of feedstock in 2 out of those 73 days. So just because you can, go all out and do a large production run in one day, well, if then there's a bunch of mechanical problems and you have to do repairs over the next few days, well, your average production is going to be much lower. And the fact that they were only able to achieve this for 2 days out of 73 days means that they're obviously, still having some mechanical problems. And it's also important to look at the wording. They said that they twice processed more than 200,000 pounds of feedstock. But processing 200,000 pounds of feedstock is not the same thing as producing 200,000 pounds of output, because as they had previously disclosed, 25 to 35% of their feedstock is co-product 2, which is a contaminant that has to be removed. So once you remove that contaminant, the actual amounts of polypropylene is only 65 to 75% of the feedstock. And of the polypropylene that is within the feedstock, no system is ever going to be 100% efficient. So some of that polypropylene is almost certainly going to be lost in the process. So that 200,000 pounds of feedstock that they're processing is significantly less than 200,000 pounds of actual output that they are producing. So that's something that's very important to consider. So they also claim that the company has compounded approximately 500,000 pounds of plastic to date. And they also are planning to compound 1 million pounds of plastic in September. And then they'll try to increase even more from there. So that sounds pretty good on the surface. They're going to produce 1 million pounds of compounded product in the month of September. However, this doesn't really tell us that much because they have not yet disclosed, at least not to my knowledge, of the compounded product, what percentage of that is the recycled polypropylene that they make versus what percentage of that is virgin polypropylene. Because remember, compounding is when you mix the recycled plastic and virgin plastic to create a mixture of it. We don't know what percentage is actually PureCycle's recycled plastic, and we also do not know the economics of the agreements they have with the compounders. So we don't know how much it's going to cost them. We don't know how much PureCycle is going to have to pay their third-party compounders to actually produce this 1 million pounds of compounded product. So while it sounds good that they're throwing out this 1 million pound number, there's still a lot of question marks about what exactly that means and what the economics are going to be. Now, we also have to look at the economics of the plant and how much it actually costs them to operate the plant. So if we look here, this is a screenshot from their SPAC presentation, which they released, I think, all the way back in 2020 or 2021, where they gave their projections for the expected economics of their facility, of their plant, of their recycling plant. So they've expected to generate they expected to produce 107 million pounds of output of recycled plastic. That would generate them $97 million of revenue. The cost of the feedstock would be $18 million. The operating cost of the plant would be $31 million, and that would leave them with $48 million of EBITDA. So they claim that this plant, once fully operational, would achieve $48 million of EBITDA. Well, if we look at the current numbers, it does not look like this type of EBITDA is going to be achievable anymore. And the reason I say that is because according to their most recent 10Q, in the second quarter of 2024, they reported $22 million of direct operating costs related to their plant. Now, if you annualize that $22 million in the most recent quarter, that's $88 million of operating costs per year. Now, that's way higher than the 31 million that they originally projected. In fact, the difference of their current run rate of operating cost versus their original projections, the difference is $57 million annualized. And this $57 million unfavorable variance in annual operating costs is greater than the projected EBITDA of the plant. So just based on how much more it's costing them, that would wipe away all of the EBITDA and actually make it so that this plant would make a loss, even if they do get to their full, nameplate capacity. And it's actually even worse than that because the economics, as far as the revenue that they're going to generate per pound, are probably also going to be much worse than expected. As we described earlier, the the quality of the recycled product they are producing is almost certainly much worse than expected because they were originally planning to just sell their recycled polypropylene as it is to customers who would then use it to make plastic products. Now that's not happening because there's imperfections and impurities in their recycled product. It has to be compounded with virgin plastic. The fact that they have to do this compounding means that their product quality is worse. Given that their product quality is worse, the economics are almost certainly going to be worse than what they originally projected. So if you take everything in totality, they're have massive delays, massive cost overruns. The plant is costing way more than expected to the plant is costing way more than expected to operate. And even if they are able to ramp up production, there's no reason to believe that they would achieve anything close to their original targets given how many unfavorable variances there are. And so now that we've talked about their operational problems, let's dig into the financing component. Also, as Ryan explained near the beginning of this video, they are in a desperate financial condition. As of June 30th, 2024, the company only had $11 million of unrestricted cash on their balance sheet, and they had $250 million of debt. In the first half of 2024, they had burned $104 million of negative free cash flow. So they were basically on the brink of bankruptcy, having just a couple months, about a month left of cash left. Actually, just a few weeks of cash left. So they desperately needed to raise capital. Well, on September 11th, that's exactly what they did. They raised $90 million from Celebra Capital Management and Samlin Capital. So we'll delve into Celebra Capital a bit later, but let's just look at the terms of this capital that they raised. So they issued $50 million of preferred stock that will mature in 3 years at an 8% return. So preferred stock is technically equity, it's technically stock because it's junior to debt, but it functions similar to debt where they have to give a preferred stock dividend, which is sort of similar to an interest expense. It's technically not interest expense, but we can think of the preferred stock dividend, this 8% yield, as kind of like an interest expense. And then they also issued 8.5 million new shares to raise proceeds of $40 million. So between the preferred stock and the common stock, they raised $90 million. And PureCycle also issued a bunch of warrants to Celebra that can execute at $11.50 per share, which is above the current share price. So Celebra will benefit if PureCycle's share price increases a lot. And then finally, in addition to being an equity investor in Celebra, in addition to being an equity investor in PureCycle, Celebra is also a lender to PureCycle, in that Celebra previously gave PureCycle a $200 million line of credit, and that line of credit, I think it originally was supposed to expire in 2025. As part of this deal, they extended that line of credit through 2026. So it's there's a very significant financial relationship now between Celebra and PureCycle. And just to delve a little bit deeper into this line of credit, so Celebra originally gave a line of credit to PureCycle back in March of 2023, but they extended it multiple times, and now it's been extended to 2026. The interest rate on this line of credit is 17.5%, which is an insanely high, interest rate for a company to be paying. So this is, I would say almost a usurious interest rate of 17.5% that Celebra will be receiving if PureCycle has to draw on their credit line. Now, this debt burden is going to be very significant for PureCycle because PureCycle already has, before this transaction, PureCycle already had $250 million of debt. In the second quarter of 2024, they incurred $12 million of interest expense. Now, with the addition of this preferred stock, they're going to be incurring an expense. Well, it's technically not an expense, but they will be incurring, they'll have to be paying $1 million per quarter of preferred stock dividends as a result of them having issued this preferred stock. So their, interest expense, if you also include the preferred stock dividend, is going to be increasing to $13 million per quarter. And that's a huge amount of interest in preferred stock dividends you need to be paying for a company that has still not reported material revenue and is many years away, and is nowhere close to being profitable, right? And for a company like that to already have so much interest expense, I think is a pretty desperate situation, especially given the fact that they have this $200 million revolving credit facility at a 17.5% interest rate. If they have to start drawing on that credit facility, given how high that interest rate is, their interest expense is going to explode even higher. And this is all before, this is all while they're very far away from becoming profitable, if they could even ever become profitable. And then we're going to delve a little bit deeper into Celebra Capital. So Celebra Capital is currently the single largest shareholder of PureCycle's common stock. They owned, as of June 30th, they owned 18% of PureCycle stock. Now they just participated in this equity raise, so they actually invested even more money into PureCycle on September 11th. So they now own more than 18% of PureCycle. So Celebra owns almost 20% of the company. Now, Celebra is a hedge fund, and you might think, okay, this hedge fund is investing into PureCycle, and they're investing such a huge amount of money into PureCycle. Isn't that a vote of confidence? Well, maybe it's a vote of confidence, but it could also be a sunk cost fallacy because Celebra already owns such a massive position in PureCycle. If PureCycle were to go bankrupt, then their position, goes to zero. And then Celebra would have a massive loss in their portfolio. So every time that PureCycle is about to run out of money, because they were about to run out of money as of the beginning of September, and then Celebra says, okay, we'll give you another investment, give you a little bit more money so that you can survive for another couple quarters. Well, then what happens a couple quarters from now, they're going to burn through that as well. And Celebra's going to have to keep pumping in more and more money. So it seems kind of like a sunk cost fallacy where Celebra is continuously pumping more and more money, investing into PureCycle, increasing its ownership stake every time, just because they want to inject cash into the business to prevent it from going bankrupt. And um, just because a hedge fund, in this case Celebra Capital, is investing in PureCycle, that does not mean that PureCycle is a good investment. Because I think a lot of people have a misconception, where hedge funds are these big fancy Wall Street guys who have access to a huge amount of information and are very smart, so they would do their due diligence and only invest in a company that is actually good. Well, the empirical evidence points to the fact that this is usually not the case. And in fact, a lot of hedge funds are not very smart in reality. Because, as one example, this is a bit unrelated, but I'm trying to make the point that hedge funds can make bad investments, was that back in 2021, George Soros's family office invested $2 billion into the electric vehicle startup Rivian. And this was a massive position for Soros's hedge fund. Now, George Soros is a hedge fund manager who is considered by many to be a legendary investor, and he is a multi-billionaire. Yet he invested $2 billion into Rivian, and Rivian was perhaps the most obviously and outrageously overvalued IPO ever. Yet he invested $2 billion into it and suffered a 90% loss on about 1/3 of his portfolio. So, even people who are supposed to be smart, these like hedge fund guys, can make extremely dumb decisions. And many academic studies have researched the returns of hedge funds, and the S&P 500 index outperformed hedge funds over the past 10 years, and it wasn't even close. So most hedge funds actually underperform the market. So the fact that this Celebra Capital is continuing to double down on PureCycle and invest more and more money into it, that does not change my opinion about the company. We can see the operations. We can see how PureCycle has all these delays and everything is worse than expected. And it's basically a disaster of a company. The fact that this hedge fund is, pumping in a bunch of money, that does not change my view. It just means that this hedge fund is throwing good money after bad and probably suffering from a sunk cost fallacy because they've already pumped so much money into the company. So I think that pretty much wraps it up for everything we had to talk about PureCycle. As always, if anybody has any opinions or thoughts about the PureCycle, please let us know in the comments section below, and we will see you all on next week's video.